Support and resistance are often taught as simple horizontal lines on a chart. Neat, mechanical, almost comforting. But that surface-level explanation is exactly why so many traders misuse them, and then wonder why price seems to slice through their perfect levels like they were never there. After decades in the market, through bubbles, crashes, and long grinding ranges, I can tell you that support and resistance are not lines. They are memories, and those memories live not on the chart, but inside the collective psychology of market participants. Until you understand that you will keep drawing levels and blaming the market when they fail, instead of asking the harder and more useful question of why they mattered in the first place. When I was younger, I treated support and resistance as rules. Price hits support, it should bounce. Price hits resistance, it should fall. If it didn't, I assumed I drew the level wrong. That belief kept me busy, but not profitable. What experience eventually taught me is that support and resistance do not cause price to move. They are areas where decisions were made before and where unfinished business still exists. Traders remember where they made money, where they lost money, and where they hesitated. Institutions remember where they accumulated or distributed size. When price returns to those areas, behavior changes not because of a line, but because of memory. True support and resistance begin with context. A level that forms after a long trend means something very different from a level that forms inside a range. Support created by aggressive buying into panic carries more weight than support created by slow, low-volume drift. Resistance formed after a violent rejection tells a different story than resistance formed after weeks of sideways trade. Beginners see levels as static. Professionals see them as chapters in an ongoing story about who was trapped, who was rewarded, and who is still waiting. One of the most important shifts in my understanding came when I stopped asking whether a level would hold and started asking how price behaved as it approached the level. Healthy support does not need to look dramatic. Often it looks quiet. Pullbacks slow, candles overlap, selling pressure weakens. That tells you sellers are running out of urgency. Weak support, on the other hand, looks frantic. Sharp drops, long red candles, quick bounces that fail immediately. Those bounces are not strength. They are short covering, and treating them as real support is how traders get trapped. Resistance follows the same logic in reverse. Strong resistance often reveals itself through hesitation and failure, not instant rejection. Price pushes into an area, stalls, churns, and struggles to make progress. Buyers are working harder for less reward. Weak resistance, by contrast, is loud but hollow. A sharp rejection followed by immediate re-entry often means supply is being absorbed. Many traders short that first rejection, aggressively not realizing they are providing liquidity to stronger hands. Another mistake people make is drawing support and resistance too precisely. Markets are not precise, they are probabilistic. Support and resistance are zones, not ticks. When you draw razor-thin lines and expect surgical reactions, you force yourself into binary thinking, right or wrong, hold or fail. That mindset leads to frustration and overtrading. When you think in zones, you allow for testing, probing false breaks, and acceptance, and suddenly, price action makes more sense. The market is not disrespecting your level, it is exploring it. Time frame matters enormously. A support level on a weekly chart can absorb dozens of intraday breaks without losing significance. A resistance level on a 5-minute chart may be irrelevant in an hour. One of the most expensive habits I had to break was reacting to lower time frame noise at higher time frame levels. I learned the hard way that if a level matters, it will reveal itself over time, through behavior, not through a single candle. Impatience is the enemy of understanding here. There is also a dangerous illusion around support and resistance that feeds ego. Traders want to believe that drawing the right levels gives them control, that if they just mark the chart correctly, outcomes will follow. But support and resistance are not predictive tools. They are diagnostic tools. They tell you where to pay attention, not what will happen next. The moment you treat a level as a promise instead of a question, you stop reading the market and start arguing with it. Some of the clearest lessons I learned about support and resistance came during crises. In 2008, levels that had held for years failed in days. Traders who treated them as guarantees were destroyed. Traders who treated them as information adapted. They noticed how quickly price moved through prior support, how little demand appeared, how bounces lacked depth. The lesson was brutal, but clear. When support fails easily, it tells you something about urgency and fear, not about bad charting. Equally important is understanding role reversal. Old resistance can become support, and old support can become resistance, but not because of magic. It happens because traders who sold at resistance regret missing more upside and want to buy on a pullback. Traders who bought at support and were stopped out want to sell on a retest to get out even. These emotional residues create supply and demand shifts. When you understand that role reversal stops being a pattern you memorize and becomes behavior you recognize. Volume, when used correctly, adds depth to support and resistance. Heavy volume with little price progress suggests absorption. Light volume through a level suggests lack of interest. But volume is a secondary clue, not a crutch. I've seen traders hide behind volume indicators the same way others hide behind oscillators, instead of observing the simple truth of whether price is accepted or rejected over time. As the years passed, I noticed that the traders who truly understood support and resistance didn't talk much about lines. They talked about patience. They talked about waiting to see who shows up at a level. They talked about letting the market reveal its hand instead of trying to force a trade just because price touched a drawing. Their charts were not crowded, but their thinking was deep grounded in context rather than prediction. And this is where the real work begins, because understanding support and resistance conceptually is one thing, but learning how to use them without turning them into rigid rules or false certainty is something else entirely. And that requires shifting from drawing levels to building a decision framework around how price behaves at those levels, how risk should be defined when you're wrong, and how patience becomes the real edge when the market is testing an area rather than responding immediately. And that transition from seeing levels to trading behavior is exactly where we need to continue next, as we move from understanding what support and resistance truly represent into how to apply them intelligently in real trading decisions without overconfidence or hesitation, and how to let the market confirm or invalidate your idea rather than demanding that it respect a line you drew, because that demand is where most traders quietly lose money and clarity at the same time. And that is where we continue next, as this sentence carries forward into the practical application of support and resistance as living zones of decision, rather than static objects on a chart that are supposed to work, simply because you labeled them and believed in them strongly enough by letting price do the talking, instead of forcing it to respect your expectations. Because the moment you use support and resistance as rigid rules rather than observational tools, you turn a source of clarity into a source of conflict. The first practical shift is learning to wait at levels instead of acting immediately. When price enters a support or resistance zone that is not your signal to trade, it is your signal to observe. You watch tempo volatility and follow through. Does price slow down or accelerate? Do candles overlap or expand? Are attempts to move through the zone accepted or rejected? This waiting feels uncomfortable, especially for traders who want certainty. But patience at levels is where information accumulates and where poor trades quietly eliminate themselves. Risk definition comes next, and this is where support and resistance become truly useful. You are not buying because price touched support. You are buying because price failed to move lower in a meaningful way. That failure gives you a logical place to be wrong. If price accepts below the zone after showing hesitation, the idea is invalid. The same logic applies at resistance. You are not shorting because price reached a level. You are shorting because buyers could not sustain progress above it. When trades are built around failure and acceptance rather than touch points, stops become structural instead of emotional, and losses stop feeling personal. Another important habit is aligning the level with your time frame. If your trade idea comes from a daily support zone, your decision-making must tolerate daily noise. Lower time frame breaks inside that zone are not failures, they are tests. Many traders sabotage themselves by zooming down and reacting to movements that are irrelevant by definition. Once I learned to only let the time frame that defined the level also define the outcome, my exits became calmer and my entries more selective. Noise lost its power because it no longer had authority. Support and resistance also work best when combined with market phase awareness. In trending markets, support is often shallow and resistance is temporary. In ranging markets, both are more respected and rotational. Treating every level the same, regardless of phase, is a common mistake. In strong trends, waiting for perfect reactions at support often leads to missed trades. In ranges, chasing breakouts through resistance often leads to traps. Context decides how much weight a level deserves. Levels do not exist in isolation. They exist inside behavior. One of the most valuable lessons I learned was to stop needing levels to work immediately. Strong areas often require multiple tests. The first touch attracts aggressive traders. The second traps them. The third reveals whether real interest exists. If you expect clean reactions every time, you will overtrade and overreact. When you accept that probing is normal, your expectations adjust and frustration fades. Markets explore before they commit and support, and resistance zones are exploration zones first and decision zones second. Role reversal becomes much clearer when you think this way. When old resistance turns into support, it is not because the market respects the line, but because behavior has shifted. Sellers who once controlled the area are gone. Buyers who missed the move are now active. If price returns to that area and holds through acceptance, the story has changed. If it fails quickly, the reversal was superficial. Watching how price behaves after the role swap tells you far more than memorizing the concept itself. Over time, you start to notice that the best trades around support and resistance often feel less exciting than the worst ones. There is no dramatic bounce, no instant payoff. Instead, there is quiet stability, reduced volatility, and gradual follow-through. That boredom is a feature, not a flaw. It means the market is comfortable with the direction, and comfort is what sustains, moves, not excitement. The deeper truth is that support and resistance do not simplify trading. They demand maturity. They require you to accept uncertainty, to wait without acting, and to let go of the need to be right at the exact level. When you embrace them as areas of decision rather than guarantees, they become powerful filters. They tell you where not to trade as much as where to trade, and avoiding bad trades is far more valuable than finding perfect ones, and that is the real payoff. Support and resistance used correctly do not predict the market, they organize your attention. They tell you where to slow down, where to define risk, and where patience matters most. If this lesson resonated with you, I invite you to subscribe to the channel so you can continue learning from real market experience rather than rigid formulas. And leave a comment sharing where you struggle most with support and resistance, weighting risk, definition, or overconfidence. Because naming that friction is often the first step toward turning these levels from lines on a chart into a living framework. You can actually trade with consistency and calm